Something is happening in America right now, and most people haven't fully realized how serious it is. In just the last 5 years, the cost of basic living in the United States has exploded at a pace we haven't seen in decades. Groceries are up over 30% since 2020. Rent has jumped more than 25% nationally. The average mortgage payment has nearly doubled since 2021, and household debt just crossed a record $18 trillion. At the same time, nearly 60% of Americans say they are living paycheck to paycheck, and a growing number of families are now using credit cards or buy now, pay later apps just to afford food. That's not normal for the richest country in the world. Something fundamental is shifting in the American economy, and the reality is life in America is getting harder for millions of people. The question is, why is this happening now, and what does it mean for the future of the American middle class? Let me ask you something honestly for a second, because this is the part nobody in Washington seems to want to talk about. When was the last time you walked into a grocery store, grabbed what you thought were basic everyday items, and didn't feel a little shock when you saw the total at the register? I'm not talking about luxury items or some giant shopping cart packed with steak and wine. I'm talking about normal stuff. Eggs, milk, bread, maybe some chicken, maybe a few vegetables, cereal for the kids, peanut butter, things that used to be considered the absolute basics of life in America. Because the reality is grocery prices in the United States have climbed at one of the fastest rates in modern history. According to the USDA, food prices rose roughly 25% to 30% between 2020 and 24. But that number actually hides the real story, because certain staples have exploded far beyond that. Eggs at one point surged more than 70% year over year. Ground beef has climbed nearly 40% in some regions. And even something as simple as a loaf of bread, the most basic food in Western civilization, has quietly crossed $5 or $6 in many major cities. And what's really crazy about this is that wages haven't kept up even remotely close. Average hourly earnings in the U.S. have grown around 4 to 5% annually, which sounds decent until you realize food, housing, and insurance have been rising much faster than that. So what ends up happening is something economists call real income erosion, which is basically a fancy way of saying your paycheck buys less every single year, even if the number on your salary technically goes up. And you're already seeing the consequences of this everywhere. Food banks across America reported record demand in 2024 and 2025, with Feeding America estimating that over 44 million Americans rely on food assistance at least part of the year. Even more surprising, a huge percentage of those people are actually working full-time jobs. In other words, the problem isn't unemployment anymore, it's affordability. Families are working, but the cost of living is simply outrunning them. And this is where things start getting uncomfortable. Because the United States used to be a place where grocery shopping was almost invisible financially. It was routine, it was predictable, it was something you did without even thinking about it. But now, more and more households are planning meals like they're running a financial spreadsheet, calculating which foods they can afford that week, comparing store brands, skipping items that used to be staples. When basic food starts becoming a budgeting crisis in the wealthiest economy on earth, that's usually a signal that something deeper in the system has shifted. And most people haven't fully realized it yet. The rise of the working poor in America. Now here's where things start getting even more concerning, because grocery prices are really just the surface symptom of something much bigger happening underneath the American economy. And that bigger shift is the quiet return of something economists thought the United States had mostly solved decades ago: the working poor. This is the group of people who have jobs, sometimes multiple jobs, who show up to work every day, who do everything society told them they were supposed to do. And yet they still can't keep up with the cost of living. According to the U.S. Bureau of Labor Statistics and several recent household surveys, roughly 60% of Americans now report living paycheck to paycheck. And what's really surprising is that nearly 1/3 of those households earn over $100,000 a year. Think about that for a second. A six-figure salary used to represent financial security in America. In the early 2000s, earning $100,000 placed you comfortably in the upper middle class. Today, in many major cities, it barely covers the basics. Housing alone is one of the biggest reasons why the median U.S. home price has climbed above $420,000, nearly double what it was in 2012. While mortgage rates have hovered between 6% and 7%, which dramatically increases the monthly payment. Rent hasn't been any better. The average rent in the United States has crossed $2,000 per month in several metropolitan areas, meaning a typical renter now needs to earn close to $80,000 annually just to afford housing without being considered cost-burdened. But it doesn't stop there. Add health insurance, which for a family can easily exceed $22,000 per year in total costs. Student loan payments averaging $300 to $500 a month. Car payments that now average over $700 per month. And suddenly you start seeing why people who technically earn good incomes still feel like they're constantly falling behind. The system hasn't just gotten more expensive, it's gotten structurally heavier. Every category of life now requires a larger percentage of income than it did a generation ago. In 1980, housing typically consumed about 25% of household income. Today, for many Americans, it's 40% or more. Healthcare has nearly tripled as a share of household spending since the 1990s. Education costs have increased over 170% since 1980, far outpacing inflation. And when you stack all those pressures together, what you end up with is a situation where millions of people are working harder than ever but feeling poorer every year. That's the strange paradox of modern America. On paper, the economy still looks strong, but on the ground, the financial pressure is quietly building. And the uncomfortable question that comes out of all this is simple. If working full-time no longer guarantees financial stability, what exactly happens to the promise of the American middle class? The hidden explosion of household debt nobody is talking about. Here's something that should honestly make you stop for a second, because this is one of those numbers that almost sounds unbelievable until you actually look it up yourself. While Americans are struggling to keep up with groceries, rent, insurance, and everything else getting more expensive, household debt in the United States has quietly reached the highest level in the country's entire history. As of 2025, total U.S. household debt has surpassed $18 trillion, according to the Federal Reserve Bank of New York. And what's really shocking is where that debt is coming from. Credit card balances alone recently crossed $1.2 trillion, which is the highest ever recorded. And the average credit card interest rate is now sitting around 20% to 24%, meaning people aren't just borrowing money. They're borrowing money at extremely expensive rates just to stay afloat. Think about what that actually means in real life. When someone puts $3,000 of groceries, gas, and bills on a credit card at 22% interest and only makes minimum payments, that balance can take years to pay off and end up costing almost double the original amount. But that's exactly what millions of households are doing right now, because the math simply isn't working anymore. In fact, a recent LendingTree survey found that nearly 40% of Americans have used credit cards to pay for basic necessities like food or utilities in the past year. That used to be something people did during emergencies. Now it's becoming normal behavior. And then you add in student loans, which total more than $1.7 trillion nationwide. Auto loans that have surged past $1.6 trillion. And something even more surprising, Americans are now financing smaller and smaller purchases that used to be paid for with cash. Buy now, pay later services like Affirm, Klarna, and Afterpay have exploded in popularity. And analysts estimate that more than 1 in 4 Americans have used these services to buy everyday items. Not electronics or furniture, but groceries, clothing, and household supplies. In other words, people are increasingly spreading out payments just to manage weekly living costs. Economists sometimes call this financial fragility, and it basically means households are operating with almost zero margin for error. One unexpected expense, a medical bill, a car repair, a rent increase, can instantly push someone deeper into debt. And here's the part that should really get your attention. Roughly 37% of Americans say they could not cover a $400 emergency expense without borrowing money or selling something. That statistic has barely improved in the past decade, despite record stock markets and a growing economy. So while headlines talk about GDP growth and corporate profits, underneath the surface, a huge portion of the population is slowly accumulating more and more financial pressure. And history shows that when large numbers of households start relying on debt just to survive everyday life, it usually means the system is entering a very unstable phase, the kind that doesn't stay hidden forever. Now let's talk about something even more unsettling, because it helps explain why life feels harder for so many people, even when the economy is technically growing. Over the last decade, the United States has experienced something economists describe as a cost of living acceleration, where the essential expenses required to maintain a normal life are rising faster than the overall economy and faster than wages. And this isn't just about food prices. Housing, healthcare, insurance, childcare, and transportation have all surged in ways that completely reshape what it means to live a middle-class life. Take childcare, for example, because this one statistic alone shows how dramatic things have become. The average cost of childcare in America now exceeds $14,000 per year per child. And in some states it's closer to $20,000. That means a family with 2 young children could easily be paying $30,000 to $40,000 a year just so both parents can go to work. And that's before you even consider rent or a mortgage, which for many households is already the single largest expense. According to housing data from Zillow and Redfin, the typical mortgage payment for a newly purchased home in 2025 is now more than double what it was just 10 years ago, largely because home prices skyrocketed while interest rates climbed back above 6%. Healthcare is another category that has become almost shockingly expensive. The average annual premium for employer-sponsored family health insurance now exceeds $24,000. And even if an employer covers part of it, workers are still paying thousands of dollars out of pocket through deductibles, copays, and prescription costs. Then there's transportation. The average price of a new car in the United States has climbed above $48,000, and the average monthly car payment is now roughly $740, which means millions of people are spending nearly the same amount on their car each month as previous generations spent on rent. When you add up all these categories, housing, healthcare, food, childcare, transportation, utilities, something pretty startling emerges. The basic cost of maintaining a stable middle-class lifestyle in America has increased dramatically faster than income for most households. In fact, several economic studies estimate that the purchasing power of the American middle class has effectively stagnated or declined over the last 20 years, once essential costs are accounted for. And that's the part that creates this strange feeling people keep describing, where it seems like everyone is working more but getting less ahead. The economy itself might still be expanding on paper, but the price of participating in that economy is becoming heavier every single year. And when the cost of simply existing in a system rises faster than people's ability to earn within it, eventually something has to give. Either the system adjusts, or people begin to fundamentally change how they live, work, and plan their future. The quiet collapse of the American safety net. For decades, the United States had a series of financial safety nets that helped stabilize people when things went wrong. Pensions, stable employer health care, affordable education, predictable housing costs, and long-term job security. But over the past 40 years, almost all of those systems have slowly eroded, and the consequences are now becoming impossible to ignore. Back in the 1970s and 1980s, many Americans who worked full-time for a company could rely on something called a defined benefit pension, which guaranteed income for life after retirement. Today, fewer than 15% of private sector workers have access to pensions, compared to nearly 60% in the early 1980s. Instead, workers were pushed toward 401k plans, which shift the responsibility and risk of retirement entirely onto the individual. That might sound reasonable until you realize that nearly half of Americans have less than $100,000 saved for retirement, and about 1/4 have nothing saved at all. Healthcare has followed a similar pattern. Employer-provided coverage used to be far more comprehensive and affordable, but today deductibles alone can exceed $3,000 to $6,000 per year for a family, meaning people often pay thousands before insurance even begins to help. And then there's job security itself. In previous generations, people frequently worked for the same company for decades. Today, the average worker changes jobs roughly 12 times during their career, and entire industries can shift almost overnight due to automation, outsourcing, or corporate restructuring. What this creates is something economists call structural insecurity, where people are constantly exposed to financial risk without the protective systems that used to soften economic shocks. Even government programs are under strain. Social Security, which supports over 70 million Americans, is projected to face funding shortfalls within the next decade if reforms aren't made. Medicare spending continues rising rapidly as the population ages. And while these programs are still functioning today, the long-term uncertainty surrounding them adds another layer of anxiety for younger generations trying to plan their financial future. The result is a country where more responsibility has been transferred onto individuals than at any point in modern history. If you lose your job, get sick, face a rent increase, or encounter unexpected debt, the margin for recovery is much smaller than it once was. In other words, life hasn't just gotten more expensive, it's gotten more fragile. And that fragility is something millions of Americans are starting to feel in very real ways. The new reality. Even high earners are struggling. And this is where the story takes a turn that surprises a lot of people. Because for a long time the assumption was that rising costs mostly affected lower-income households. But what we're seeing now is something different. Even people earning what used to be considered strong salaries are feeling squeezed by the modern cost structure of American life. According to recent data from financial institutions and economic surveys, a significant portion of households earning $100,000 to $150,000 per year report living paycheck to paycheck. That sounds almost impossible until you actually break down the numbers. Imagine a dual-income household earning around $120,000 annually before taxes. After federal, state, and payroll taxes, their take-home income might drop to roughly $7,000 per month, depending on where they live. Now start subtracting the essentials. A typical mortgage or rent payment in many metropolitan areas can easily reach $2,500 to $3,500 per month. Add childcare, which could cost another $1,200 to $2,000 monthly. Health insurance premiums and medical costs that might total $800 to $1,000. A car payment around $700. Student loan payments averaging $400 to $600. Groceries that can exceed $1,000 for a family. And suddenly most of that income is already spoken for before entertainment, savings, emergencies, or retirement contributions even enter the picture. This is why financial stress is increasingly being reported across income levels that historically felt stable. In fact, surveys from organizations like the Federal Reserve and Pew Research have shown that financial anxiety among middle and upper-middle income households has risen significantly over the past decade, largely because expenses tied to housing, healthcare, and education have accelerated far beyond income growth. But there's another factor making this situation even more shocking. In many industries, job stability itself has weakened. Corporate layoffs have become more frequent in sectors like tech, finance, media, and consulting. Fields that once offered some of the most secure professional careers. When someone earning six figures suddenly loses their job, they may still carry the same fixed costs. Mortgage payments, childcare, insurance. But without the income that supported them, that's how households that look comfortable on paper can suddenly find themselves under extreme financial pressure. And this is the part that reveals how much the structure of American life has shifted. A few decades ago, earning a strong salary usually meant financial breathing room. Today, in many parts of the country, it simply means you're running faster on a treadmill that keeps getting steeper every year. The American dream is quietly becoming a luxury. If you worked hard, stayed responsible, and followed the rules, you could build a stable life, buy a home, raise a family, and slowly move up the economic ladder. That idea became known as the American dream, and for most of the 20th century it was actually achievable for millions of people. But when you start looking at the numbers today, something very different is happening. Homeownership, which was once considered the cornerstone of middle-class wealth, is becoming increasingly out of reach for younger generations. The median home price in the U.S. has climbed past $420,000, while mortgage rates hovering around 6 to 7% mean the monthly payment on that home can easily exceed $2,800 to $3,200, depending on the down payment. Just 10 years ago, that same house might have cost half as much with interest rates under 4%. And the consequences of that shift are enormous, because housing is the primary way Americans historically built wealth. According to Federal Reserve data, roughly two-thirds of middle-class wealth traditionally came from home equity, not stocks or savings accounts. But if younger households can't afford homes in the first place, that wealth-building engine essentially disappears. This is why the average age of a first-time homebuyer has climbed to nearly 38 years old, the highest level ever recorded. In the 1980s, it was closer to 29. That nearly decade-long delay changes everything. When people buy homes later, they build equity later, start families later, and retire with less accumulated wealth. And the same pattern shows up in other life milestones too. Marriage rates are declining. Birth rates have dropped to the lowest levels in American history. And younger adults are staying with parents longer than at any time since the Great Depression. A recent Pew Research study found that 1 in 3 adults under 35 still lives with family. Not because they want to, but because housing and living costs have become so overwhelming. The result is that the traditional path of adulthood, stable job, house, family, long-term financial security, is slowly shifting from a standard expectation to something that feels more like a luxury achievement. And the truly shocking part is that this transformation hasn't happened through one dramatic event. It's been a slow, gradual change driven by rising costs, stagnant wages in many sectors, and economic systems that increasingly reward capital ownership over labor income. The American dream hasn't officially disappeared, but for millions of people it has quietly moved further and further away, like a finish line that keeps getting pushed back no matter how hard you run. The economic divide is growing faster than ever. But the most shocking shift of all might be the one happening between different groups inside the same economy. Because while many Americans are struggling with rising costs, another segment of the population has actually become dramatically wealthier during the same period. Over the last decade, the United States has experienced one of the fastest expansions of wealth inequality in modern history. According to Federal Reserve data, the top 10% of Americans now control roughly 70% of the country's total wealth, while the bottom half of the population owns less than 3% combined. That gap has widened significantly since the early 2000s, and much of it comes down to how modern wealth is created. Today, most wealth growth comes from owning assets, things like stocks, real estate, businesses, and investment funds. And when you look at what happened after 2020, those assets skyrocketed in value. The stock market surged to record highs, housing prices exploded, and technology companies created trillions of dollars in new market value. For households that already owned assets, that period created enormous gains almost overnight. But for people who didn't own assets, renters, younger workers, households living paycheck to paycheck, those same price increases actually made life harder because the cost of buying those assets rose dramatically. It created what economists sometimes call a K-shaped economy, where one group of people experiences rapid financial growth while another group falls further behind. You can see this divide in everyday life if you pay attention. Some neighborhoods are booming with luxury apartments, high-end restaurants, and expensive cars. At the same time, food banks are reporting record demand. Homelessness has increased in multiple cities, and millions of households are struggling to pay basic bills. Even retirement tells the same story. Households with strong investment portfolios saw their wealth multiply during the last decade, while millions of others approach retirement with little or no savings, and that divide is beginning to reshape how people view the future. Surveys consistently show younger generations expressing far less confidence that they will achieve the same level of financial stability as their parents. In fact, one recent study found that more than 60% of young adults believe the economic system is stacked against them, a level of pessimism that economists say hasn't been seen in generations. The danger in a situation like this isn't just economic, it's social. Because when large portions of a population begin to feel that the system no longer works for them, frustration builds. And historically, periods of rapidly growing inequality often become turning points for societies. The question now isn't whether the divide exists. The numbers make that very clear. The real question is what happens next when more and more people begin to realize just how wide that gap has become. Now here's the part that should really make you stop and think. Because when economists zoom out and look at the bigger picture, what they're seeing is not just temporary inflation or a few expensive years. What they're seeing is the beginning of what could become the most expensive era in American history, where the baseline cost of living resets permanently higher than previous generations ever experienced. And the reason for that is something most people don't realize. Many of the forces driving these price increases are structural, meaning they don't easily reverse. Housing shortages alone are a massive example. The United States currently has an estimated housing deficit of over 4 million homes, according to data from Freddie Mac. And building new homes has become slower and more expensive due to zoning restrictions, higher construction costs, labor shortages, and expensive land. That means housing prices are unlikely to dramatically fall anytime soon because the supply simply isn't there. Healthcare costs show the same pattern. The U.S. healthcare system already spends more than $4.5 trillion per year, which is nearly 20% of the entire U.S. economy. And that number continues rising as the population ages and medical technology becomes more expensive. Education costs have followed the same trajectory, with college tuition increasing over 170% since the 1980s, leaving millions of Americans with long-term student loan debt that affects their ability to buy homes, start businesses, or even save for retirement. But the most surprising factor driving this expensive new era might actually be something people rarely connect to everyday life. Government debt and money supply expansion. The United States national debt has surpassed $34 trillion, and servicing that debt requires massive ongoing spending. Historically, countries often manage large debt loads through moderate inflation over long periods of time, which slowly reduces the real value of that debt while prices across the economy gradually rise. In simple terms, that means inflation isn't always a temporary accident. Sometimes it becomes part of the economic strategy. When you combine that with global supply chain shifts, energy costs, demographic changes, and technological disruptions in the job market, you begin to see why economists increasingly believe the cost of living may continue climbing even if official inflation numbers cool down. This creates a future where life in America might look very different from what previous generations experienced, where housing, healthcare, childcare, and education consume a larger share of income than ever before. And if that trend continues, the definition of what it means to live a normal middle-class life may change dramatically over the next decade. Something fundamental is changing in the American system. But when you step back and connect all these pieces together, the rising grocery bills, the record household debt, the collapsing safety nets, the expensive housing market, and the growing wealth divide, a bigger realization starts to emerge. What we're seeing may not just be a temporary economic cycle. It may actually be a fundamental shift in how the American system works. For most of the last century, the United States built its economic model around upward mobility. The idea was simple. Each generation would generally live better than the one before it. That promise fueled innovation, hard work, entrepreneurship, and optimism about the future. But several recent studies show something surprising. According to research from economists at Harvard and Stanford, only about 50% of Americans born in the 1980s are earning more than their parents did at the same age, compared to over 90% of people born in the 1940s. In other words, the probability of surpassing your parents' economic success has dropped dramatically over time. That doesn't mean people aren't working hard. In fact, many are working harder than ever. Americans work longer hours than most developed nations. Productivity has increased dramatically over the last several decades, and technological progress has made industries far more efficient. Yet the benefits of that productivity haven't been distributed evenly. Much of the economic growth has concentrated in specific sectors, cities, and asset classes rather than broadly lifting living standards for everyone. That's why you're seeing this strange contradiction in the modern economy, where stock markets can hit record highs while large portions of the population feel financially squeezed at the same time. And when that gap grows large enough, societies usually reach a turning point. Sometimes systems adapt through policy changes, economic reforms, and new opportunities that rebalance growth. Other times, the adjustment happens more slowly as people change their behavior, delaying families, relocating to cheaper regions, leaving expensive cities, or even moving to different countries entirely. But what's becoming clear is that the economic environment Americans grew up expecting is evolving into something different. Life in America isn't necessarily collapsing, but it is becoming more complex, more competitive, and more expensive than many people anticipated. And the question millions of Americans are now quietly asking themselves is not just how to survive in this new environment, but whether the rules of the system that once defined the American dream are being rewritten in real time. Before you go, think about this for a second. Everything we just talked about, the rising grocery bills, the record debt, the housing crisis, the shrinking middle class, none of this happened overnight. These changes have been building slowly for years, and now millions of Americans are starting to feel the pressure all at the same time. And the truth is, this story isn't finished yet. The economic system is shifting in ways most people don't fully understand, and what happens next could reshape how people live, work, and build wealth in America for the next generation. So I want to hear from you. Are you feeling this where you live? Have your groceries, rent, or bills gone up more than your income? Let me know down in the comments, because real conversations like this matter. And if you found this video informative, make sure to subscribe, because we're going to keep breaking down the changes happening in the economy that most people aren't talking about. Stay informed, stay prepared, and I'll see you in the next one.